Earlier this morning, an analyst at Wedbush went out and lowered their price target on SoFi from $5 a share to $2.5 a share. Now, coincidentally on Friday, another analyst initiated a buy coverage on SoFi with an $8 price target. There's naturally a huge variance between those two, and in this video, we're going to be looking at both of those analysts and trying to find some logic within their price targets. Okay, so let's first get started with the Wedbush analyst, but before I do that, I want to just highlight that I missed SoFi Weekly last week. I am not in the country. I'm traveling for this month, and SoFi Weekly in my time zone is about 4 a.m. I think Amit, Tanner, and Steven killed it. I watched the replay the next morning. I think they brought up a lot of interesting topics on the wider fintech space as opposed to just SoFi. But being in another time zone, coincidentally, I caught this Wedbush news in the middle of my day. I tweeted about it live in the moment, providing some of my thoughts. So let's first run through these tweets and then take a look at the note itself. So I first tweeted news around this downgrade saying that SoFi was downgraded with a $2.5 price target from $5 and that the stock is down around 7% in the pre-market hours. This was around 6:30 a.m. Eastern time when the note was first released. I followed up with a second tweet posting the tip ranks rating of this analyst, David Chiaverini, who is rated 0.5 stars out of 5, ranked 7,942 out of a total of 8,300 analysts out there with an average success rating over the past year of 39%. So immediately there was some bias going into it, but I wanted to provide my opinions, taking my bias for SoFi out of it. And so I was thinking of this in the context of me owning any company, right? If any company that I were holding lowered their price target twice in 2 weeks, when nothing material really changed about the company, I would doubt anything that this analyst would say, because what it means to me is that it means that they haven't done the proper due diligence the first time around, that they're now adjusting their price target again the second time around in 2 weeks. And they're big adjustments too, right? The first downgrade, I continue in my tweet, was that they lowered their price target from $8 a share to $5 a share, since the outlook raise that SoFi provided was a not big enough raise that they wanted. Keep in mind, everything is in turmoil in the banking industry. There's going to be a few winners and a lot of losers. That warranted a 40% lowering in the price target from $8 to $5. Now, not only did this analyst stop there, but they lowered it again by another 50% from $5 to $2.5 now, saying that fair accounting value may present headwinds. Basically, in this tweet, I highlight that there is zero proportionality in the rationale that they're providing, meaning that they're cutting this by huge amounts for seemingly insignificant or very small changes, given the context of the macro environment of where we stand. And then I tweeted again, a third tweet shortly after, saying that a part of me would love to see Anthony Noto or Chris Lapointe give a short commentary on the accounting, as this was the primary reason for this downgrade, and to ease the pre-market overreaction as the stock was down significantly in the pre-market. However, another part of me wants them to stay silent, wants them to ignore this noise and stay as far removed from this analyst as possible, to not basically give credence to anything that this person is saying. And I think that Anthony Noto will make a statement. It just won't come in the form of PR. It'll probably come in the form of a Form 4 when he buys more stock this week or next week. Now, after I made this tweet, there were some interesting comments that were highlighted. One comment said that, actually something did change. Student loan forgiveness was announced that it's over, a huge positive for SoFi. Another comment highlighted that it seems odd when a buy rating from Truist came in on Friday, which we're going to talk about right after this, and it didn't spark a major increase in the share price, but it's such a hard hit downwards when the second analyst downgrades the stock. So a discrepancy there between the analysts. The third comment says, it makes me wonder whether there were ulterior motives. Maybe there was somebody looking to exit a short position out of this. So a lot of sentiment here from retail investors around potential manipulation. So now let's take a look at the note to try to understand why. Now, in the note itself that was released with this downgrade, the analyst explains that there could be a downside risk to SoFi's gain on sale margins and their fair value marks of its loan portfolio, highlighting that there were minimal actual loan sales during the first quarter, but we fear that when SoFi does start selling loans again, that there could be a material negative impact on the fair value of their loan portfolio. They continue to say that we believe not selling loans in the first quarter could imply that a gain on sale margins aren't trending at similar elevated levels than those generated last year, or that the market for loans may have weakened. We fear that if SoFi were to execute a loan sale today, we believe the sale execution level could be lower than previously achieved and could lead to a material reversal of gain on sale income, a potential decline in asset value, and a decline in tangible book value, even though the analyst downgrade is significantly lower than SoFi's book value. But put in simple terms, essentially what this analyst is concerned about is about how SoFi is handling its loans, inferring that since SoFi hasn't sold any loans since the start of the year, that this could be problematic if they do decide to start selling again. Now, they sold quite a bunch of loans towards the back half of 2022, and they didn't really sell any loans in the first quarter, which they talked about in the earnings call. Now, the analyst extrapolates this to say, well, it could be problematic because the market could be valuing these loans at a much lower level. Thereby, when SoFi sells them, they get lower proceeds than expected, and this could negatively affect their finances, right? They'll get less money from these loans. Now, I think there's a few things wrong with this. Number one is the funds rate. That's one thing to consider, right? The Fed has been raising rates all throughout 2022, and this latest hike of 25 basis points, I think was the last one or close to the last one, maybe the second last one that we're going to get. The Fed is unlikely to raise interest rates much higher than this. They've highlighted this time and time again, meaning that we are unlikely to see a higher federal interest rate loans 6 months from now than we are to see it today, since the Fed will not continue to raise rates into the future. In fact, SoFi management in this latest call held to their previous guidance, their full year 2023 guidance, saying that they predict that the Fed was actually going to cut rates 2 times towards the end of this year. So if the Fed cuts rates, that makes the value of SoFi's loans go up, not fall, because the higher the interest rate, these loans would essentially be more valuable. Now, one other thing that raised red flags with me was the analyst is using Lending Club's methodology as a main comparison point to SoFi. And as we know, there's a lot wrong with this as well. For starters, SoFi preemptively moves faster than the Fed rate hikes with regards to their coupons, while Lending Club lags behind by quite a bit in their changes. So SoFi is basically predicting what the Fed is going to do, and then they make their change faster, whereas Lending Club waits, they see what the Fed does, and then they make their change reactively to the Fed. So that's one distinction. Another distinction is the whole discrepancy between loans held for sale and loans held for maturity. These are 2 different models, and obviously if the core model is different, then you can't really make an apples to apples comparison between these companies. Not to mention that the analyst in their note flat out got some things wrong, which Vadim made a great Reddit thread about, and I'll link that in the description below for further reading. But I don't want to dive too far into the nitty-gritty points highlighted by this analyst. I think the recommendations of any analyst are only as strong as their reputation. And in this case, this particular analyst has such a low reputation, I think that their recommendation is going to carry a weight that's corresponding what their reputation is, which is why people find holes in their arguments hours after they release their note. Now, by contrast, moving away from Wedbush into an analyst who I think actually gets SoFi is Truist. Andrew Jeffrey is the analyst who highlighted a new coverage of SoFi on Friday with an $8 price target. They went on CNBC to explain the rationale. Let's listen to the clip together.
Amid the recent bank turmoil, my next guest says we could see more of a shift to digital banking and see it pick up speed. As a result, he's initiating SoFi with a buy, calling it the future for the industry. Why SoFi and not PayPal? Is it Block, whoever owns Cash App, or why not Robinhood? I mean, why this one?
I think the thing about SoFi that makes it different is it's truly a bank. It's an FDIC insured depository institution. It has terrific vertically integrated technology from our standpoint, a leading app with a very slick UX, and most importantly, it's a chief beneficiary of some of the disruption we've seen in the banking industry. You can see the company has increased its deposits tenfold over the last year, and it's deploying those deposits into what we view as very profitable, predominantly personal loans, also some student loans and mortgages, all through a single app, all data driven. We think that really sets it apart.
You know, one of the things that they mentioned was that the thing that makes SoFi different is that it's truly a bank. They're the chief beneficiary of the disruption in the banking industry. And this is something that we've been talking about time and time again on the SoFi Weekly podcast. I mentioned in previous episodes, especially after Q1 earnings came out, that for every loser out there, for every Silicon Valley bank, for every Signature Bank, for every First Republic that loses its depositors, there has to be some beneficiary in that market, right? And so I think that SoFi is going to be one of the main beneficiaries, winning all of the business that some of these other regional banks are losing.
So when I think about all of these fintechs, I think, okay, Robinhood, I'm going to go trade stocks. I think, who else? Cash App, obvious. Venmo, obvious. SoFi, I think, refinance student loans, right? Like how would SoFi, how would I be involved with SoFi, right, at this point if I'm not in that particular market right now?
You're right about how the company got its start. It has subsequently diversified pretty significantly. Its biggest product is personal loans. And the idea is you attract people to the platform to use the checking and savings account, especially with a very high 4.2% yield, which is obviously a lot higher than banks. That's how they're attracting deposits, although that funding cost is less than the secondary markets for their loans. So it's helping their margins. And then they really help you, as they say, get your money right, make better financial decisions, but perhaps consolidate debt, lower interest rate payments, et cetera. I'm a customer myself, and I was attracted initially by the high APY, but certainly being able to consolidate my accounts all in one place, have a look at all of my assets in one place, get free financial advice, et cetera, I think is a truly differentiating aspect. I suspect it's going to play to a younger demographic,
right?
But I think that's fine. I think that's the future.
Now, just pausing here, some of the other things that I really like is that this analyst highlights the need for the consolidation of different financial assets, this all-in-one, one-stop shop motto that SoFi is really emphasizing as their core business model, this whole ecosystem. Now, here the CNBC announcer really touches on the high customer acquisition cost, the increase in marketing spend. Remember, we talked about this last week, that the marketing spend has been going up while the member growth has been staying consistent, around 450,000 members per quarter. And this is something by design that the company is trying to cap their member growth at 450,000 so as to maintain the higher quality borrowers as their core members.
I guess my concern is a little bit like we saw with direct-to-consumer e-commerce plays. In other words, over time, are they going to have a high cost to compete and retain and attract customers through, like you said, either offering very high yields on their accounts or simply through advertising? I mean, at some point, all these fintechs are a commodity, and it's all about who's best known, most out there with marketing spend. And a lot of the consumer DTC plays have blown up as a result because their business models aren't sustainable.
Yeah, I think it's a fair question. This company does have very strong unit economics, about 3 times LTV to CAC. I think the best thing about the model is that once they acquire a customer or a member through the top of the funnel via their financial products, they don't need to acquire that customer again. So you've got the customer on the platform, he or she is engaged with the products, and then begins to see the merits of additional monetizing lending products. I think the other thing that really distinguishes SoFi is their tech platform. Embedded finance, the ability to allow non-financial companies to offer financial services, is a $3 trillion market and growing very fast. It's only about 15% of their revenue today. But I suspect, especially starting next year, the growth in that segment is going to accelerate. That's a profitable business. This is an intrinsically profitable company, in my view. 23% ROE at the bank today, not necessarily at the holding company, but it is profitable on an EBITDA basis. We estimate about $280 million this year. So I think it's already proven out the profit point. Now it's got to grow fast enough and grow profitably and underwrite well in a disciplined way and maintain its charge-offs, and in that respect, it's very much a bank.
Now, one of the other things that I really like is that the analyst highlighted that SoFi is an intrinsically profitable company, that they've already proven out the profit point. I think this is one of the few analysts out there that I think truly understand SoFi's business model and what they're trying to achieve. Now, the price target that they gave, I think, is realistic, because there's 2 things to remember. Number one, that price targets are by and large 12 months out price targets. They're not really an indication of what this is going to be in the future, 5 years from now, 10 years from now. It's really 12 months from now. That's number one. Number two is that the price target is derived from all projections, right? They're extrapolated from existing numbers. The LTV, the CAC ratios, the marketing spend, the profitability points, all of these are numbers that analysts can take today and extrapolate out. A lot lot of the time, the things that we talk about on the SoFi Weekly podcast, which have the potential to take this company well into the double digits, is not accounted for in SoFi's numbers, right? Because we on the SoFi Weekly podcast talk about a longer time horizon, right? 12 months, I think SoFi executes well. They reached $8, $10, and analysts at that point will be extrapolating out further to say maybe $15 or maybe $20 price targets in the next 12 months after that. That's how it goes, right? It's iterative. And there's a reason why that happens is because they can only look as far as the data is allowing them, as their models are allowing them. Much of what we're looking at on the SoFi Weekly podcast is beyond that projection, right? Galileo's potential, this massive total addressable market, new products that SoFi is launching into their ecosystem. These are all somewhat difficult to project today, but I think these have the potential to massively propel the business. So there is a world where both of these parties are right. It's just a matter of different time horizons, right? The analysts are looking 12 months out, whereas a lot of retail investors are looking 3 to 5 years out. And of course, there's a lot of execution risk that goes into that. Can this business really execute? I think the takeaway overall, just wrapping this up, is that even still, after a great first quarter with a double beat and a raise in outlook, and not to mention showing a clear path to profitability, that there is still many analysts that just don't get SoFi. And that's fine. I mean, there could be manipulation. I won't speculate as to that. But I just think fundamentally there's a lot of people that just don't get it. And it's okay for them to not to get it, right? It's okay for not everybody to understand, because that's where the opportunity lies for the few people who do understand, like many of the viewers of the SoFi Weekly podcast, or many of the viewers of this channel, or maybe, this analyst at Truist, Andrew Jeffries. This is the opportunity for those people to take advantage over all of the noise that's in the market with this stock. Personally, I'm going to be buying more SoFi stock this week, and that's just a personal decision based on my own risk and my own time horizon, because I just think that this drop from this Wedbush analyst doesn't really hold any merit. Their reputation, in my opinion, doesn't really hold any merit given their track record, and I just think that their arguments are very weak, where retail analysts can find holes in them hours after they release them. And I know analyst expectations can sometimes seem daunting, so I really wanted to make this video to hopefully shed some light on the rationale behind a lot of these analysts. Hopefully this helped. For right now, this is the Fundamentals Investing Podcast. Thank you so much for listening.